Good morning, everyone. Without wasting much of our time, happy new semester. So, by God's grace, we're going to use a jet to cover most of the topics in both SS12 and SS12. Because time is not in our side again. So, without wasting much of our time, please, if you can see this screen, please signify. If you can see my screen, please let me know.
Yes, we can see it. Yes, sir, we can see it.
Thank you for that.
We can see it, sir.
Okay. This is SS12. So we are going to start from the first study session, which is regulatory and statutory framework of accounting. I'll be a little bit different from what is inside this manual because one, due to recent development in accounting standard, so there are so many new things that you need to understand as far as this course is concerned. Then secondly, so these materials is we're about to update it. So in due time, by God's grace, so I will try as much as possible to put another material, which is going to be an update from this. So when you're talking about regulatory framework, or what we can call regulatory and statutory framework of accounting, there should be a reason why we want to delve into this particular topic. When we are talking about regulation, in every accounting system, or let me just say, in every accounting organization, the main purpose of regulation is to ensure that the users of the financial information, they have adequate information that they can rely upon. What do I mean? For them to make an informed decision, they must have furnished with some certain level of information. Let me give you an instance. If you happen to be one of the shareholders in a particular organization, automatically you are one of the owners of that particular organization. So you need some information for you to make a particular decision at the end of the year. And this information must come from a minimum requirement of accounting information. That is why you see in every annual report, there are some minimum statement or minimum requirements that every organization must provide. One of the requirements is statement of financial position. So every users or every shareholders in a particular organization must be given a financial position, or what we can call a balance sheet. Then another information required of the organization is the statement of profit or loss, another comprehensive income. So another one is cash flow statements. So then we need statement of changes in equity. And lastly, notes to the account. So all these minimum requirements, they are very important to shareholders. For instance, so for shareholders to know the assets and liabilities of an organization, he or she must be able to go into the statement of financial position and fetch out the information on the assets and liability of that particular organization, whether the organization can be able to utilize their assets effectively. Do you understand? Or whether they can be able to sustain their liabilities. So then users should be interested in profit or loss or other comprehensive income, so as to be able to know whether they can go on and invest in that particular company. Because if a profit is making loss, there's no need for irrational investors to continue to invest in such kind of organization. So that's another important content that the users must be furnished with. Then another interesting content of financial statements is cash flow statements. So cash flow statements specifies the inflow and outflow of cash and cash equivalents. So the users should be able to know whether the organization can meet up with a day-to-day organization operations rather. Do you understand? So that's the essence of cash flow statement for them to tackle the liquidity problems that they can be experienced. So that's that about the cash flow statement. Then we have the notes to the accounts. Every other relevant information that are not monetary and in value, so they can specify them in what in the statement in the explanatory notes, in which once the user sees this kind of notes, they'll be able to make an informed decision. All these minimum contents are what the users requested for them to make an important decision. So for all these things to be in place, we need regulation. So every accounting system of every organization has to be what? Has to be regulated. So that's the essence of this particular course. So there are so many items that we must find in all this content that we are talking about. Those items must be what? Must be in line with the regulatory bodies. So now, before the advent of IFRS, IAS, and some other relevant international standards, do you understand? So we are using what is referred to as Statement of Accounting Standard, that's SAS. Do you understand? But once there is a recent development in accounting standard, the SAS has been abolished. IFRS and IAS this time around. So now, without wasting much of our time, so this is going to be the learning outcomes for this session. So once you have undergone through this particular study session, you should be able to explain the purpose of a regulatory framework. Then you should be able to understand various regulatory frameworks for corporate financial reporting, then the composition, functions, and powers of the Nigerian Accounting Standard. But we will not even do much about this because the regulatory body that are saddled with the responsibility of accounting standard presently, they are not a Nigerian Accounting Standard Board again. So Nigerian Accounting Standard Board, the committee in the board, they are part of the representatives in the international board. So we may not dwell much on Nigerian Accounting Standard. So processes involved in the production of accounting standard. So that's very, very important as well. The current statement of accounting standard issued by Nigerian Accounting Standard Board. So that may not even necessary as well. So let's quickly move to the purpose of regulatory framework. So what is the purpose of regulatory framework? Before that, let me just share this thing so be able to be on the same page. One minute. So, please, can you see the screen? Hello, can you see it?
Yes, sir. Yes, sir. We can
Yes,
see
sir.
So
We
the
can
purpose
see
of
it.
this framework, okay, thank you. The purpose of this framework is to assist the IASB. So that's the first thing, to assist the IASB. Who are the IASB? So I will try as much as possible to emphasize on this IASB later after this purpose to assist the ISB in the development of future accounting standards and its review of existing standards. Have it in mind, the framework is not an IAS or neither IFRS. So the framework is neither IFRS nor IAS. But there are some situations whereby there will be a conflict between the IFRS and the framework. You know, we said the framework is to assist the ISB, and the ISB, they are saddled with the responsibility of what? Issuing IFRS. That's the thing that you need to understand. So ISB, they are the one that are what? That are issued IFRS. But we said the framework assists the ISB. Automatically, the framework is not the IFRS. They are two different things. So, but in case of a conflict between IFRS and the framework, it is the IFRS that will prevail. So get that gist. So then, another important purpose of this framework is to assist the ISB by providing a basis for reducing the number of alternative accounting treatments. That is, you know, we have so many treatments in accounting. Do you understand? But the purpose of framework is to reduce this alternative framework. So we will not be able to have a conflict of interest as far as the accounting treatment is concerned. So another thing is assist national standard setting bodies in developing a national standard. So we are making use of harmonized standard, whereby every country in the world will be using the same accounting content. For instance, the statement of financial position produced by a particular company in Nigeria would be the same, the process undergone through producing a particular statement of financial position will be the same for all other countries in the world, because we are using the same accounting treatment. So that's the reason why we want to harmonize the accounting standard. So assist accountants to apply relevant accounting standard in preparing financial statements and dealing with topics that do not form the subject of international accounting standard. So then it also assists accountants in forming an opinion whether financial statement conform with relevant accounting standard. You know, there's a basis for, there's a room for judgment in accounting, because when we are talking about artificial intelligence, that the AI has taken most of the work of an accountant, you understand, because there are some artificial intelligence platform now. If you just supply a particular information, it will bring out what you need. For instance, if you want to prepare a financial statement for a particular company, so once you're able to supply the required information to the system through artificial intelligence platform, so whatever you are requested for will be provided by the AI. But I don't think AI can provide a judgment, do you understand, for an organization. So that is why we still need an accountant. Accountants still relevant in every organization. So now, it also assists users of financial statements in interpreting the information contained in the financial statement, prepared in conformity with international accounting standard. You know, the end point of providing or producing a financial statement is for the essence of what? The users. It is for the consumption of what? The users. The users are the main reasons why every organization is providing or producing a financial statement. So without the users, the financial statement is meaningless. Do you understand? So the framework assists users of financial statement in interpreting the information, because once you're able to get the required information that you need, do you understand, as a user, to be able to form your opinion whether to go home with the organization or not. So that's the essence of what? Essence of financial, the essence of framework. So that is what we need to understand as far as this framework is concerned. So let's continue with our material. So now I will try as much as possible to emphasize much. So if you look at your materials, under the purpose of regulatory framework, we have the following, which is not different from what we have just discussed. So the first one here is that they said, ensure uniformity in the preparation and presentation of a corporate report throughout the country. You know, I said something about harmonization. I said the main reasons why we have international accounting standard setting bodies is just to ensure uniformity in preparation and presentation of financial report. That is, the account prepared in Nigeria must follow the same process with the account that you are going to prepare in another country. Do you understand? That's the sense of international financial reporting standard or international accounting standard we are talking about. So ensure that accountant comply with the general account accepted accounting principles in discharge of their function. That's GAP. So ensure that the standard comply with the existing regulatory framework. So there are no difference with what we have just discussed, but that one is a more bit complex with this one. So now, various regulatory framework for corporate financial reporting. You know, I say something that I'm going to be a little bit differ from what is inside this because the main reason is that we are talking about international accounting standard now. We are not talking about Nigerian accounting standard. Do you understand? So, but we cannot do without all these various regulatory framework, like the Central Bank of Nigeria, the Nigerian Insurance Commission, the Security Exchange Commission, because all these regulatory, all these bodies, they are part of what the international accounting standard setters. So they have representatives in international accounting body setters. So they are very, very important. But let me just try to say something about International Accounting Standard Board. Because when we are talking about IASB, we are talking about and don't forget the International Accounting Standard Board. Before the advent of IASB, there is what is referred to as ISC. That is International Accounting Standard Committee. Do you understand? So now, this is, so we have this. So IASB, they are the one saddled with the responsibility of producing IFRS. Then IASC, they are the ones saddled with the responsibility of producing IAS. So now, before the advent of what's it called? IASB. Before IASB, we have ISC. And the ISC is International Accounting Standard Committee. International Accounting Standard Committee. So they are the one responsible for producing the International Accounting Standard, IS. If you see IS1, IS2, IS5, 7, IS11, all these IAS, the work of what? International Accounting Standard Committee. Exactly. So now, the International Accounting Standard Board, which is IASB, started in 2001. Do you understand? So this IASB, they are the one responsible for producing IAS, IFRS rather. Do you understand? So they work with the framework. That is, the framework assists the IASB in producing IFRS. Am I making any sense? So now, when we are now talking about IASB, what are the reasons why IASB comes into play? Do you understand? So we have the structure of IASB. That's the main structure of IASB. So what are the composition of what? IASB. So the composition of IASB, we have IFRS Foundation. IFRS Foundation. IFRS Foundation is International Financial Reporting Standard Foundation. Do you understand? So before, IASC Foundation, we have IASC Foundation. So those are the ones regulating IAS. So, but the IASC Foundation is just for only non-for-profit making organization. That's one of the limitations of IASC Foundation. But now we are using IASB Foundation. That is International Accounting Standard Board Foundation. Do you understand? So the IASB Foundation or the IFRS Foundation, they based in United States of America. Do you understand? So in July 2010, IFRS Foundation, they have 22 trustees. Exactly. So they have 22 trustees. So that are monitoring and funding ISB. So that's their functions. So they are doing what? They are monitoring and they are funding what? ISB. So this IFRS Foundation that we are talking about, they now have two stems. Do you understand? So they have what is referred to as IFRS Advisory Committee, IFRS Advisory Committee, and IFRS Interpretation Committee. So those are the two important segments of IFRS Foundation. So they have IFRS Advisory Committee, then IFRS Interpretation Committee. So what was the main function of IFRS Advisory Committee? The main function of IFRS Advisory Committee is they are the standard setting process, or let me just say standard setting bodies. So their major role is to advise the ISB in all the financial reporting issues. That's their main function. The main function of IFRS Advisory Committee is to advise the what? Is to advise the ISB in what? In every financial reporting issues. So, IFRS Foundation Advisory Committee. Then we have IFRS Interpretation Committee. So they are the ones saddled with the responsibility of assisting IASB, do you understand, by improving existing standards. So, we have IFRS, for instance, we have IFRS 1, first-time adopters of IFRS. So it is in existence already. Do you understand? If there should be an improvement in that particular IFRS, do you understand? It is the responsibility of IFRS Interpretation Committee to assist the ISB. Don't forget, ISB are the one responsible for what? For issuing IFRS. Do you understand? So then they also saddled with the responsibility of clarifying any issues. Let me give you an instance. Look at about presentation of financial statements. So IFRS 10 now talks about financial statement as well. Exactly. So now, it has been repealed. The IS of it has been repealed by IFRS 10. So IFRS 10 is now in operation. Do you understand? So we cannot accept IFRS 10 unless it has been interpreted by what? By IFRS Interpretation Committee. And they have clarified the issues therein. Do you understand? So that's the main function of what? IFRS Interpretation Committee. So, I said ISB, they are formerly known as ISC. So there's just a little difference. ISC, they are the ones who will be responsible for issuing IS, that International Accounting Standard. Why the ISB are the ones saddled with the responsibility for producing IFRS. So ISB currently they based in United Kingdom, that's UK. Do you understand? So they are the one with the issues IFRS. Do you understand? And they have issued 13 IFRS since 2000 1 to date. No, sorry, 14. So there is IFRS 16 currently, IFRS 16. So we have IFRS 16. So now, so that's the main work of what? Main work of IASB. So now let us look at the impact of globalization. I said something the other time. I said we want to harmonize the accounting standard. So the accounting standard, we might find it difficult to harmonize it if if the entire country or entire world is no longer a global village. But for the fact that the entire world is the accounting standard, so the need for harmonizing financial reporting standard arises as a result of what? Globalization of business activities. Why there's a harmonization of what? Financial reporting standard. So the main purpose of harmonizing this accounting standard, that is what we can term as the impact of globalization, is to provide a platform for investment choice. Or let me just say, is to provide a platform for wider investment choice. So that's one of the main. Who is Damilare? You are disturbing this class. Damilare, you are disturbing this class. I will remove you. So what I'm trying to pass across is the main purpose of harmonizing is just to provide a platform for wider investment choice, then to promote lower cost of capital. Do you understand? So it will help us to reduce our cost of capital, then to provide more efficient capital markets. Do you understand? When all the accounting system has been organized, so it will help us to provide more efficient capital market. And finally, it will help us to provide an enhanced business development. So that's the main reasons why we need to harmonize our accounting standard. So what are the process of producing an accounting standard? So that's the next line of action. So what are the process of producing an accounting standard? I've said something the other time. I said a particular standard, you can't just produce a particular standard unless there are so many things have been put in place. For instance, we have IAS. IAS is still in operation because every relevant IAS, they are still in operation. Do you understand? But once an IAS has been produced and the new IFRS on that particular issue has now been produced, so that one will repeal the former IAS. So now what we are seeing here is IASC gradually they are dying. That is International Accounting Standard Committee, because they are the one producing IAS, and there is no longer IAS again. So automatically the IASC has been changed to IASB. So IASB are now saddled with the responsibility of producing IFRS. Do you understand? So now we have some process in producing a particular standard. So that's why I say the IFRS Foundation, they are divided into two. We have IFRS Advisory Committee and IFRS Foundation Interpretation Committee. Do you understand? So IFRS Interpretation Committee, they are the one who issues IFRS, and they also clarify some issues. So the procedures to be followed or to be adopted in the production of accounting standards is divided under section of the Government Amendment Act. Galaxy M30, please, you are disturbing this class. Galaxy M30. They are disturbing our class. So the choice of a particular topic for standardization has to be put in place. So because any items, if there is a particular item that you need to include it in IFRS, so that particular topic needs to be discussed. Do you understand? So prepare and publish exposure draft. So when the topic has been chosen, do you understand? So we need to provide or to publish an exposure draft. This exposure draft will now be something. So now we are talking about the process of producing IFRS, right?
Yes, sir. Yes, sir.
Okay. Thank you. Let me share the screen again. So I said the next line of action is to prepare and publish an exposure draft. Are we on the same page? Can you hear me?
Yes, sir. You are very loud.
Okay, thank you. So then after which you now allow for at least 3 months for comment by all the stakeholders. That is all the interested parties. They have to bring out their own comments. Do you understand? Their contributions to that particular topic. Then you now conduct a public hearing where necessary. So then you incorporate all reasonable additional ideas to a comment. Then a statement, or what we can term as what IFRS will be issued. So that's how they are issuing a particular standard. For instance, look at IFRS 4 insurance contracts. It's not as if they just get some information online, so they have to follow all this process. Oh, the choice of the topic is insurance contracts. So they have to prepare and publish an exposure draft, whereby all the interested stakeholders or parties, do you understand, they will be informed. Then they will now allow at least 3 months for comment by stakeholders. It's just something that you can just do within 5 or 10 days. No, you allow at least 3 months for all the stakeholders to add their own comments and contribute. Then conduct a public hearing where necessary. They incorporate all reasonable additional ideas. So if there's any idea that are very essential to that particular topic, you have to incorporate it. Then finally, you issue a statement of accounting standard. Now say IFRS 4 is now in operation. That is insurance contract. So the same thing they did for IFRS 3, that's business combination. So IFRS 1, that's first-time adopters of IFRS. Then we have IFRS 2, that's share-based payment transactions. So all the IFRS that you can think of, so that's how they are produced. Then, so statement of accounting standard issues. This is issued by the Nigerian Accounting Standard. I've said something about this one that I'm not going to dwell much on it because we are no longer using statement of accounting standard. So we don't need to waste much of our time as regards that. So that is that
sorry,
about.
Sorry, sir, we are not seeing your screen, sir.
You are not doing what?
Your screen, sir. Can you please share your screen, sir, so that we'll be seeing what?
Okay, you can't see the screen again.
Yes, sir.
Okay, sorry.
All right, sir. Thanks.
So what I'm trying to say here is that, this is where I stopped. So I said, statement of accounting standard issued. Do you understand? So that I'm not going to say much about this because we are no longer using SAS. We are using IFRS. Do you understand? An IAS. But the IAS is going to an extinction. Do you understand? It's going into an extinction because some of the IFRS has repealed the IAS. So now, fully in years to come, we'll be using only IFRS, that's International Financial Reporting Standard. Exactly. So that is that about the study session 1. So now, before we leave this study session 1, I will try as much as possible. Let me go straight. Before this one comes up, let me quickly talk about the study session 2. So study session 2 talks about the concepts of accounting, which we can also refer to as accounting concepts and policies. Accounting concepts and policies. You know, I said something the other time, said the end product of every accounting information is to produce a financial report. And the financial report that we are producing is not for our own consumption, it's for the consumption of what? The users. That is the users of accounting information. So once they have this information, they'll be able to make an informed decision. So, but before a particular statement, let me say financial statement, can be prepared, so the accounting concept and policies must be strictly adhered to. Do you understand? They must be what? Strictly adhered to. So the accounting policies we are talking about specify the basis used by a particular business or organization and regarded as appropriate to the circumstances of the business activities. So that is the basis in which every organization will base their financial statements on. So that's what the accounting concept and policy is try to address. So we have the following concepts in line with generally accepted accounting principles. That's GAAP. Do you understand? So in the preparation of what? The financial statement. So we have the entity concept. Do you understand? So the entity concept assumes that a company or corporation is a separate entity on its own. It can be sued. It can sue and be sued in a court of law. What they are trying to tell us here is that, let me use a particular language as a layman. Entities concept simply means the business purse and the private purse, personal purse, I mean, they have to be what? Separated. Once you are into a business, you must not allow your personal purse and your private purse to be what? Mingles together. For instance, you want to pay for your student, your child school fees. Do you understand? You now say, oh, let me just take from my business purse to pay. No, even if you don't have any money with you, you have to borrow that money from your what? From a business purse. Do you understand? So as to be able to separate your own personal purse from your business. So that's what entity concept is trying to tell us. So the concept assumes that the company or a corporation is a separate entity on its own. Do you understand? So that's what the entity concept is trying to address. Then we have going concern concept. So every business organization assumes no intention to curtail the scale of operations. Do you understand? You can't have a business now and say in the next 5 years, so I will close down the business. No, every rational business-oriented individuals must be able to have a foreseeable future for that particular business. Do you understand? So the going concern concept assumes that an organization will continue to operate for the foreseeable future. No intention to curtail the scale of operation. So that's what the going concern concept is talking about. So the balance sheet, which is known as statement of financial position, and profit and loss account assume no intention to liquidate or curtail the scale of operation. So that's what they are talking about going concern concept. Then we have realization concept. This concept recognizes revenue as soon as it is what? Capable of objective measurement, and the value of asset is reasonably certain. realization concept. That is, your revenue must be what? Must be realized. Do you understand? Not that we'll be using a treasury account or any form of vague accounts. And the value of assets that you are using, that you want to be utilized, must be reasonably certain. Do you understand? So that's that about realization concept. Then we have matching concept. When we are talking about matching concept, we should be able to talk about our revenue and our costs. So the revenue, or what we can term as income, and our costs must be merged together. You must match them together. So what they are saying here is that you should be able to know the amount of money that you have invested and the amount of money that you have realized. So and you match them to the extent that the profit or loss reward should be certain. So then we have double entry principle. So double entry principle, as we all know from our elementary accounting, that's every transaction should have two entries. We have the credit entry and we have what? The debit entry. Do you understand? For every debit entry, there must be a corresponding credit entry. If I give out money, so I'm the giver, somebody must have received the money. So we have the debitor and we have the what? The receiver, the creditor and the receiver. So now that's what double entry try to address. So when there is a debit entry, there has to be a corresponding credit entry for proper accountability. That's what we are interested in accounting. We have to accountable for every one kobo spent in an organization. So that is why if one money is strained out, we must identify the source of receiving the money, the source that receives the money. The source that the money is going out must be identified, and the source receiving the money must be also identified. So then we have consistency concepts. Consistency in the sense that every like item within each accounting period should be treated the same way. For instance, if you want to prepare, if you want to calculate a depreciation, for instance, and you are using straight line method this year, you have to be consistent with that particular method. Do you understand? If you are using actuarial method, you have to be consistent with using the actuarial method in the subsequent years. That is why when you see a financial report, most times you see 2 years compared together in a particular financial report. When you are preparing a financial report of 2023, you will see the report of 2023 and 2022. So if you are using a particular depreciation method of depreciation in 2021, and you are using different depreciation method in 2023, it will affect the comparison. So that is why consistency concept is an important concept in accounting. Then we have prudency concept. So prudency concept in the sense that the income is actually realized, not estimated. We don't need to estimate our income. We must actualize or realize our income. Let me give you an instance. Sometimes they will say an accountant, they are what? They are very stingy. It's not that the accountants are very stingy. It's just that the accountant, they have to account for every 1 naira kobo spent. Every money come out from their pocket, they have to account for it. Once they are able to account for it, whether they use the money with something that is not even relevant to their life, they are not concerned. But it has to be what? It has to be well spent and actualized. For instance, if an accountant wants to spend 5 naira, so the first question that the accountant will ask in our service, why do I need to spend this 5 naira? Do you understand? If he can provide the answers for that particular question, automatically that will now prompt him to another question: that what is going to be the economic benefits that I'm going to derive from spending this particular 5 naira? So if he or she can provide answers to that questions also, so the accountant will now say, okay, let me spend it. But when you are saying that to your friend or to anybody, they will say, your accountant, you are very stingy. So it's not as if they are stingy, they are being prudent, because every income should be what? Should be actually realized, not estimated. So prudence and realization concepts are basic concepts in determining profit made by what? By the organization. Then we have periodicity. So this concept assumes that transactions should be separated into a particular period for easy matching of revenue with what? With expenses. So that is why, every accounting period is usually a year. Do you understand? So then we have historical concepts or historical cost concept. So this assumes that items should be stated at their original cost of purchase rather than realizable value. When you buy an asset now, so you have to state that particular asset at the original cost. That original cost is referred to as historical cost. So that is why most of the things in financial accounting are based on what? On historical cost concept. So let me quickly go to the LMS and see what I want to show you. So, financial reporting and regulatory framework, or let me just say the international accounting standards, they see to every business organization, not only private or public organization, but also SMEs. Do you understand? Small and medium scale enterprise. So now, is this thing slow like this? One minute. Okay. So then what are the accounting methods? Accounting method is just the medium through which accounting concepts are applied to financial transactions in the preparation of financial statements. What we are saying about accounting method is that what is the mechanisms? Do you understand? What is the mechanisms through which this concept that we have been discussing since that can be applied for us to prepare our financial statements? So that is the method to be adopted and applied by what? By the organization. So we have two bases for this. We have accrual basis and we have cash basis. But due to the recent development in accounting standard, so IFRS, they are mainly deals with what? Accrual basis of accounting. So although before cash basis is using all these profit and non-profit making organizations, all these government parastatals, but presently it is the accrual basis that is in operation. So that is that about basis used in preparation of financial statements. If I ask you, what is the basis used in preparation of financial statements? Plus an accrual basis of accounting. So accounting policies, every organization or corporations has a policy used in preparation of its accounts. So we have different policies. So that is why I said something at the initial stage of this lecture. I said, judgment is allowed. There are some items that may not be discussed in IFRS or the framework. You can use your own judgments to. Hello, I'm sorry for the interruptions. Please, can you hear me?
I hear you, sir.
Yes, sir. I can hear you.
We can hear you, sir.
Okay.
Can hear you, sir.
So we are talking about the accounting policies. That is the use of accounting policies. So and I said something that the policies adopted by an organization are based on personal judgment and the suitability presenting the true and fair view of the result of an organization. Therefore, there is a need for management to be careful and rational in their choice of accounting policies. So there are some principles that they need to be followed. So, and those principles will serve as what? As guide. So one of the principles that we are talking about here is substance over form. So substance over form. This principle states that generally the legal form of every transaction is a basis for recording its commercial status in the book of accounts. So, but there are instances whereby the legal status differ from the what? from the commercial status. So this particular substance over form tells us that for every transactions, the transactions should be what? Recorded in what? Should be recorded using the commercial status rather than what? Rather than legal status. So in such instance, the commercial status shall be recognized rather than what? The legal form. For instance, in the finance list, that's IFRS 16. Do you understand? So the commercial status is recognized by including the assets acquired as part of the fixed or non-current asset of the lessee, despite the fact that the legal title remain with the lessor. You know, when we are talking about finance lease, so the lessor has granted the lessee the right to use that particular asset for a considerable number of period. So, but the legal title of that particular asset still remain with what? With the lessor. But when the lessee want to include that particular transaction in his own book, it is the commercial status of what? Of that particular assets that needs to be what? Recorded. So we have objectivity. So the principle of objectivity states that an accountant should be fair and unbiased. When you are objective, so it simply means you are fair in dealings and you are unbiased. So in the process of recording, calculating, summarizing, you don't allow your own personal interest to affect the accounting treatment that you are dealing with. So this implies that the accountant should be fair to all users of financial information and also treat transactions without emotion. You understand? So the transaction must not be treated with what? Treated without emotions. So then we have what is first as materiality. So under the materiality principle, this holds that only items of material values should be recorded or should be included in the accounting treatment. So any items or any elements that are immaterial should be excluded. So that's what materiality simply tells us. Then we have prudency. So revenue and profit are not to be anticipated, but recognized. We don't need to estimate anything, but we need to actualize our revenue and our profits. So then we have the fairness principle. So this is just a product of what's being objective. So it emphasizes the need for accountant not to be what? Influenced by any users, but to prepare accounts based on acceptable principles. Then, so those are the principles that we need to understand as far as what the users of accounting policy is concerned. So this is an illustration of accounting policy. So we have the basis of accounting, we have consolidation, then we have goodwill treatment, then we have investments, we have fixed asset depreciation. When we get to calculation aspect of this course, we delve much on this information. Then implementation of accounting policy in annual reports and accounts. So if you want to learn this, hello, who is that? Hussein Wahab, you are disturbing us. So what we are trying to tell us here is that how do we now implement the accounting policy in our annual report? So I said something the other time. I said we have basis of accounting. We have that we need to include in our financial statement. Do you understand? So excerpt from the annual report an account of Leon Bank of Nigerian PLC. They are using a particular single entity bank. So these are the things, let me just say, these are the significant accounting policies that should be adopted by this particular bank. So you can see that's a policy. So exchange rate default. So this is just like preparing a mini statement that will address an accounting policy. Do you understand? So look at this one. This is First Bank of Nigeria. This is the accounting policy that needs to be included in the financial statement. So just glance through all these things. Do you understand? So then these are the things that we need to find in their what? In their financial statement as regards the accounting policies. So that's the end of this study session as well. So let me just quickly move to what I wanted to show you the other time. Can you see my LMS?
No, sir. No, sir. I'm only seeing you, sir.
Sorry. Okay. Can you see it now?
Yes, sir. We can see now.
Okay. Oh, now, I said something the other time. I said the financial reporting standard does not only emphasize for public sector organizations or private organizations, but also for what? For non-profit, SMEs. Do you understand? So now I want to show you these materials. Some additional materials that we need to learn as regards the first study sessions. So all this material is prepared in line with IFRS. Hello. Abidoye, you are disturbing us. So this material is prepared in line with the International Financial Reporting Standard. So IFRS as follows. Abidoye, who is Abidoye now? Abidoye, do you want me to remove you? Elizabeth Ojo, mute yourself. So SME is defined by IFRS as follows. So they are usually owned managed by a relatively small number of individuals, such as a family group, rather than having an extensive ownership base. You can see. So usually owned managed by a relatively small number of individuals. Do you understand? So that is SME. They are usually smaller entity in financial terms, such as revenue generated and asset and liabilities under control of the entity. So this is defined in line with the revenue generated, do you understand, and assets utilized and liability owned by the organization. So that's the definition, another definition of small and medium-sized entities. IFRS call it small and medium-sized entities. Do you understand? So what we normally use is small and medium-scale enterprises, but the IFRS call it small and medium-sized entities. So another definition is they usually have a small number of employees. So you can define SME as a small number of employees, or an entity that has a very small number of employees. So they usually undertake less complex or difficult transactions. So any entity or any transactions that are not complex in nature or that are not difficult in nature, so is handled by what? SME. Do you understand? So then another definition is its shares should not be listed on public exchange. So any entity that their shares are not listed on public exchange is regarded as what? SME. So that's the definition of SME by the IFRS. So then another important thing here is what are the problems of accounting for SME? So one possible source of confusion in developing a reporting standard for SME is that the European Union has passed directives defining small and medium-sized companies. SMEs which are not listed and which are not publicly accountable, they may or may not also meet the definition of small or medium-sized company based upon EU, that is European Union, or other national law. But there is now an IFRS for SMEs, which identifies the extent to which IFRS should be applied by SMEs, together with underlying concepts and principles to apply if a topic is not covered within IFRS for SME. Do you understand? So what they are saying here is that there is a particular standard for SME. Is that clear? So another possible problem that we may encounter here is the reporting and compliance body that has been placed upon SMEs full compliance with IFRS GAAP, particularly when they may have relatively few transactions covered by an applicable standard. You know, when we are talking about reporting and compliance, do you understand? The kind of compliance that the standard required kind of compliance required for IFRS, because when you put the same compliance required for public organizations to the IFRS, there may be a problem. So because the identity that deals with small, or let me just say, not so much difficult transactions. So it could also be argued that there may be a comparability problem. So for you to compare businesses, there should be a minimum requirement for the assets, liabilities, and some other things. So it might be a problem for SMEs as well. So SMEs are very different entities from the large listed companies that typically apply IFRS. The content of many IFRS is not relevant to the needs of these smaller unlisted, and many of them will put off adopting IFRS due to large reporting bodies. So it's an important note to take note. Then primarily, the users of the financial statement of smaller are often banking institutions who have loaned money to the businesses. In many cases, small businesses are owner managed, and their focus is on the profitability and cash generation of the business. It makes sense that these entities should have their own reporting requirements more attuned to the needs of their businesses. So that's the agitation of the SMEs owners. So there are two potential solutions to reporting for SMEs. Number one, exception from IFRS. So they have to be excluded from IFRS, because there are so many things required of all these public or corporate organizations from IFRS. If you say you want the same compliance from SME, that may be a problem. So a case can be made for requiring a lower level of disclosure from small and medium-sized entities. And some countries, this already happened. Then differential reporting. So there should be a way to report for SME and a way to report for other corporate organizations or non-for-profit making organizations. There should be, they must not have the same reporting process. So this is where a completely new set of standards is developed for small companies. So the first option is better because it does not require completely new standards to be written, and keeps both large and small companies apply the same standard, even though the smaller companies are applying abbreviated versions. So what they are saying here is that if you want to exclude IFRS and SME from IFRS, not that you exclude them from entirety of IFRS, but there are some complex compliance that they should be excluded from. So that's what they are trying to put across here. So then the ISB method is a standard alone standard. It's a standalone standard for each. The content of this will be a full IFRS that addresses transactions, events, or conditions commonly encountered by SMEs. It will provide a framework for the preparation of financial statements by a small and medium enterprise. Those accounting requirements covered by the reporting standard related to transaction, event, or condition not generally encountered by SMEs are not included in the IFRS for SME. So what we are saying is that we should have in IASB framework, we should have IFRS for SMEs. So the goal is to minimize the circumstance in which our SME will need to fall back to full IFRS for guidance on how to account for a particular transaction or situation. So if there is a particular framework for IFRS for SME, it will be quite different from those organizations that apply full IFRS. So the subject matter of several reporting standards omitted from the IFRS for SME as follows. So all this has been omitted. So we have any purchase, which is IAS 33. So interim reporting, IAS 34. Segmental reporting, IFRS 8. Asset held for sale, that's IFRS 5. So all those has been excluded from IFRS for SME. So finally, it could be argued that the simplified accounting treatment are a way of reducing judgment in the preparation of what financial statement. That is, the way we are simplifying for SME is just a way of reducing judgment in the preparation of what financial statement. For example, the judgment of whether research and development costs, that's in line with IAS 36, should be capitalized. The time and the cost incurred in obtaining and accounting for evaluation of property, plan and equipment, that's in line with IAS 16, property, plan and equipment. And then the determination of the amortization period for any capitalized expenditure is avoided by IFRS for SME. So what they are trying to tell us here is that there should be a particular case for IFRS for SME because they don't engage in complex or difficult transactions. So we should not expect them to apply full IFRS. So that's one of the major things that I need to put you through. So just go to your LMS, go and get the materials I'll need for the absence of questions.
Thank God for the beautiful lecture, sir. We appreciate the beautiful lecture, sir. My first question is this additional information just you have just gone through on the LMS. Would it also be added to the material, sir? That's my first question. The second one, when you were talking about some of the disclosure of some entities like the banks, you also mentioned that some of that disclosure in their financial statement will also relate to their financial policies. I want to ask, at what point do we have variance between their own organization financial policy and the provision of the IAS?
I don't get. You said what? Say it again. I can't hear you.
At what point do we have the variance between the organization financial policy and the provision of the international financial standard? Since the international financial standard gives the framework on which disclosure should be made. So if there's also a provision for organization financial policy in relation to disclosure, so at what point do we draw the line, sir? I don't know if you get my question.
I have network issues. Can you please ask your question again?
You got my first question, sir.
I did not even get anyone.
Okay, my first question is this additional material you just gone through now on the LMS. Will it be added to the material when the material is ready? That's my first question.
No. That's why I said just go to your LMS, download the materials for further reading.
Okay, sir. The second one, while you were talking about the disclosure in terms of the financial reporting of organizations, you mentioned that some of them mention or brings into their reporting their organization financial policies. Are you with me, sir?
Yes, I'm with you.
My question now is, at what point do we draw the line between their own personal financial policy in relation to disclosure and the provision of the IAS in relation to the standard of what is to be disclosed?
Thank you so much. The second question is not far-fetched. when you want to apply a personal judgment, you can apply a personal judgment at any point in time throughout the process of preparing financial statement. This is what I mean. Let's say, for instance, there's an item that you want to treat in a financial statement, and that particular item has not been discussed under either IAS or IFRS. Even the framework does not even explain anything about the item. So you can use your own personal judgment, and let's assume that particular item is while you are preparing your statement of financial position. You have not done with all the content of financial statement, but while you are preparing your financial statement, you are encountered that particular issue. So you can use your personal judgment at any point in time. So far, it has not been covered by IAS or IFRS. Exactly. Then when you are talking about disclosure requirement, do you understand? There are some items, they are not quantifiable in monetary terms. Do you understand? But they are relevant for decision making of the users. All those items has to be discussed under notes to the explanatory notes. Do you understand? So different from the quantifiable content like statement of profit or loss and other comprehensive income, statement of financial position, statement of changes in equity, etc. You understand? So there should be a page or notes to the accounts. So all those material items that are relevant, but they cannot be quantified in monetary terms. So they have to be discussed under disclosure, under the note to the accounts, have to disclose them. So I think that's sufficient question.
Hello, sir.
Thank you, sir.
Hello.
Yeah, I want to raise an issue. When you started with the talks, you talked about I would say, deviated from what is inside the lecture notes, and it was very significant. Like you did for SMA, can we have just some notes for us to at least go through and understand it better the way you talk on the regulatory framework?
I will do that. Don't worry.
Thank you very much,
I'm already
sir.
on it.
Oh, thank you very much, sir.
Yes. So any other questions, reactions, comments? So thank you. In the absence of questions and reactions, I think this is the best time for us to ask. So thank you and God bless you. Have a nice time. Bye-bye.
Thank you, sir.
Thank you.
Thank you, sir.
Thank you, sir.
Thank you, sir.
Thank you, sir.
Thank you, sir.